All right. JPMorgan Chase by Noah May, Reese Murdoch, Landon Ham, Hank Smith, and Ryan Stites. In 1799, JPMorgan Chase's and Company's earliest predecessor company was founded, the Manhattan Company. Then throughout the 1800s, various other predecessor companies would be founded, with key ones being the First National Bank of Chicago and Chase National Bank. JP Morgan would then help with various financial crises and developments, such as the Panic of 1893 and the Panama Canal. In 1940, the company would become public. Then throughout the second half of the 1900s, both Chase National Bank and JP Morgan and Company would merge with smaller companies. And then finally in 2000, JP Morgan and Company would merge with Chase National Bank to form JP Morgan Chase and Company. Okay. The industry. JP Morgan Chase & Co. is in the banking industry, being the largest in the United States. It is valued at over 460 billion US dollars and has total assets of over 3 trillion US dollars. There are 4 types of banks in the United States: commercial, savings and loans, and credit unions. JP Morgan Chase & Co. have used multiple of these. And then the main way that the banks make money is through lending out money to their customers to put in their account, then charging higher interest rates on those loans. And then using the money that they have received from interest, they use that to pay back to their customers. The business. JP Morgan & Co. provides financial services to their customers with its customer community banking segment, and this is the largest source of their income. This would be what you think about whenever you normally go to a bank. You have the deposits and investments, and then the cash management and mortgages, along with credit cards and auto loans. Then they have the corporate and investment bank segment, which is the investment banking, market making, prime brokerage, and the treasury and securities products, and the services for corporations, investors, financial institutions, and governments. And finally, they have their asset and wealth management segment, which provides services to all asset classes and has over 2.7 trillion US dollars under management.
The company performance for 2020 was down as a whole, mainly because of the coronavirus. As you can see, their return on investment was very low. That's due to a few factors. You can see operating income is down by 20.54%. Also, another factor is that assets increased by over 26% in the year 2020. So that would leave the average total assets way more than what they were if they increased by only, like, let's say 10%. The earnings per share had a 17.16% decrease from 2019, from $10.72 to $8.88. But a good thing to think or look at is the first quarter report on how they're doing this year in 2021, trying to bounce back from 2020. Their operating income is up 37% from last year. The earnings per share is up by 42%. And on March 31st, the earnings per share was $12.60. The net income is up by 37%. The only thing that's down is revenue, and that's only 6.5%. And gross profit is up by 7.9%.
Current events. The coronavirus in 2020 caused JP Morgan and Chase, along with all other banks, to suffer losses. But as 2021 goes on, those losses have been minimized. The introduction of stimulus checks have been a large contributor to the success of the company, as said by CEO Jamie Dimon. The company had also overallocated funds, expecting individuals to default on loans, so these funds are flowing back into earnings. JP Morgan and Chase is also aiming to finance over 2.5 trillion US dollars over the next 10 years to try and advance long-term solutions to combat climate change.
Liquidity ratios. The working capital's amount of cash that can safely be spent. In the previous years, JP Morgan had a high working capital, but then when the coronavirus hit, they set aside cash in case these loans had been defaulted on. So that's why their working capital appears to be so low. And then the current ratio is their ability to pay back, is their current liabilities are more than their assets, as seen by having a ratio below 1. But that's also for the same reason that they put away so much of their cash to these loans that might be defaulted on. And then the gross profit ratio is how successful the executive management team is generating revenue. And as you can see, it has been increasing throughout the years. The net charge-off rate is the amount of credit card debt that is likely to be defaulted on. And the average for the companies is between 3% and 0.5%. And JPMorgan's is averaging around the 0.5%, which is very good for the company. The debt ratio is how much of the company's assets are provided by debt. And since it's below 100%, that is also good for the company. And then the debt to equity ratio, it shows how much of the is including the relative proportion of the shareholders' equity and debt to finance the company's assets. And then since it is below 2, it is also considered to be good for the industry. And then the profitability ratios, the return on assets indicates how well these companies' investments generate value. And then it was considered normal until 2020 whenever COVID dropped it down. The return on common equity measures how much money common shareholders receive from the company. And theirs is average for the Fortune 500 companies. Earnings per share is how much you would earn if you have a share of their stock. And then the profit margin ratio indicates how many cents of profit the business is generating for each dollar of sale. And they're ranging around 70 cents to 80 cents. This is the 5-year stock performance comparison. As you can see, JPMorgan is above its competitors. And then you can see that other Fortune 500 company average is the square, and it is slightly above that.
So for the horizontal analysis and the importance of it, in 2020, they had an increase in total net revenue by about 3%. This was caused mostly by an increase in principal transactions by 28%, which is just their normal transactions. You may think that this increase in total net revenue was good for the company, but as you can see in the next bullet point, they had a decrease in net income, and this is caused mostly by provision for credit losses. Provision for credit losses is the estimation of potential losses due to credit risk. This is recorded as an expense, and it had a 213% increase by using horizontal analysis. And for the balance sheet, the increase in assets was 26%. This is good for the company because increasing that increasing assets usually means increasing net worth, and by investing your wealth, you can increase your more wealth. For the vertical analysis importance, the net income difference was about 7%, which is similar to what we had showing for the horizontal analysis of net income decreasing from 36% in 2019 to 29% in 2020. Another interesting thing was a disparity between interest income. There's a 20% change from 72% in 2019 to 52% in 2020, and interest income is the main way that banks make their income from interest on loans and other accounts that they manage. And another disparity for the balance sheet was loans and deposits with banks.
So 3 of JP Morgan's largest competitors are Citibank, Wells Fargo, and Morgan Stanley. Taking a look at the common size income statements, they do have a greater balance between their interest and non-interest income. They also have the lowest expenses by percent than all three of their competitors, and they have the highest net income and operating income. Even with that 7% decrease from 2019, they are still better than three of their largest competitors. And then looking at the common size balance sheet, JP Morgan has higher liabilities than equity compared to their competitors. They're generally in the median when it comes to all of their asset accounts, except property, plant, and equipment. They had the highest percentage of that. And they also had the second lowest debt by percentage compared to their competitors.
Is it worth investing? Overall, JPMorgan Chase would be worth investing in. It has had a long history of success, and although it has taken a hit due to coronavirus, it has shown that it was capable of rebounding. The stock is currently almost back to where it was pre-COVID. If you purchase equity in this company, it will be a steady source of income.